Good day. Tea with Travis. Interesting day. March Madness starts today, and so that's exciting for a lot of us that enjoy basketball. But wow, the market's taken a breather from yesterday. Yesterday was unprecedented and historic with the Federal Reserve and Ben Bernanke coming out of their Fed Reserve meeting yesterday and announcing that the Fed Reserve Bank is going to purchase $1,050 billion more worth of treasuries and mortgage backed securities on top of the $50 billion or $500 billion they've already committed to that they started buying back in January 5th. So to add those together, we're up to $1,550 billion spent or going to be spent this year on treasuries and mortgage backed securities to keep interest rates down, to stimulate mortgage rates or stimulate the economy as well as the housing industry, which sounds great on paper. But man, the bonds went on a huge rally yesterday. The 10-year Treasury note went on the biggest jump to the positive since the crash in '87, and it's pretty amazing to see the numbers that happened yesterday. And mortgage-backed securities also jumped by 137 basis points on the 4.5 mortgage note coupon. So crazy times, and I'll explain a little bit more about what that means and how that translates in a minute. But this is the reason, and out of that money, 300 billion of the 1,550 billion. 300 billion of it went to US Treasuries rather than mortgage-backed securities. And the reason for this is if all the money continues to pour into mortgage-backed securities from the Fed to Fannie Mae and Freddie Mac, then they become less valuable and treasuries become more valuable, and the yield curve between the two, the gap shortens. And so if mortgage-backed securities continue to come down and you get a mortgage rate for 4%, and you get a 2-year or shorter term treasury, a 2-year or a 10-year, and the yield is nearly the same, then investors are going to go into the short term, because if you can get your money in your return in 2 years rather than 30 years, then certainly you're going to pick the shorter term investment. So that's why the Treasury had to, or the Feds bought so much in Treasury, and they only bought only 300 billion because the number of treasuries versus the astronomical number of mortgage-backed securities is a percentage of each other. So not very much in treasuries right now. The bad news, the dollar plunged big time. I mean, it got knocked out yesterday against the euro, the yen, and a bunch of other foreign currencies, as well as oil jumped $5 a barrel almost immediately when this announcement came out, and oil's back over $51 a barrel, the first time in a couple of months it's been over $50, as well as gold jumped $60 in one day an ounce to $950 an ounce. So these are all things are going to pressure inflation, and we can't have inflation so much right now because of the economy and we're in a recession. But this definitely lines up the potential for inflation, like I've talked about even weeks ago, with the Feds buying so many of these mortgage-backed securities, and they're printing so much money, and the stimulus plan being nearly 800 billion, and all the money the Treasury is just printing right now, or the Fed's printing. It's got to cause inflation, and this announcement yesterday again just played right into that, watching oil jump, gold jump, and watching our dollar tank against other currencies. So we will have inflationary pressures, which is kind of the evil nemesis of mortgage-backed securities staying valuable. And so as much as the Feds are trying to push down mortgage-backed securities, they had to do a huge jump yesterday and dedicate this much money, because if they keep printing money, inflation is going to eat away or erode the value of mortgage-backed securities, because over 30 years, if inflation's out of control, they really become useless. And so the media took a good spin on this yesterday and said mortgage rates are going to get down to 4% and so on. I really don't think it's going to happen because of these inflationary pressures, watching the dollar tank, watching oil go up. All these things are reasons that would keep mortgage rates from really getting that low. This happened back on January 6th, where mortgage-backed securities hit their all-time high in value, meaning the lowest rates ever, were on January 6th. But we did not see at our level as a consumer, you or me as a lender or a mortgage planner, I couldn't pass that savings that we should have had on to you because of capacity issues. And now we definitely have some capacity issues. I've had mortgages for my clients this week that we almost didn't make a March deadline because money has run out for the month of March for a lot of investors. Let's say with our bank line we have $50 million on our bank line. If all the money is used up by March 20th, then we can't fund another deal until the end of the month, until April 1st. So purchases were taking priority, refinances were getting bumped. People that were expecting their refinances to close next week are now getting bumped to April 1st, and then the problem accentuates. And so now you even take rates even further down, and we definitely have capacity issues, not just with credit lines and banks with their available money to lend on a monthly basis, but also just staff issues. I mean, if a staff's used to handling 100 loans a month, and all of a sudden they get 2,000 in a month, think of the delays. I mean, right now our banks are some are at 2 weeks, some are even at a month in underwriting, docs out, funding. And if that was already the case, imagine how crazy this is going to be. So some of the profit is being held, I'm sure, simply to hire more staff, and also to support this eventual refinance plan, the DU Refi Plus program that we keep hearing about, that President Obama talked about on March 4th. It hasn't been released by any lender yet, and Fannie Mae is not even ready to release it yet. Their DU underwriting system is not even up to par yet to even approve these loans. So interesting. Rates did improve, but not as much as they should have. I mean, we should see rates at 4.375, but we're not even coming anything near that right now. I think maybe 4.75 with an APR around 5 is where we are today. Maybe 4.625 with an APR just under 5. So that's exciting, with good credit score overlays and things like that. So that's a long message, but man, there's so much to report on right now. The market's flat today. I think the market's taking a breather. Bonds are flat. I mean, mortgage-backed securities are, I think, up 1 basis point, which is basically nothing. And I think the Dow's down about 35 right now. So taking a breather today. Tomorrow might be interesting on a Friday, but other than that, some of the traders might just be watching March Madness too today and taking off early. So I hope you enjoyed the update. Please call us with any questions you have, and we look forward to serving you. And be blessed.